Now, when it comes to AMC stock, everybody's favorite thing to talk about these days is how quickly the AMC stock short squeeze is going to come. It seems like everybody knows that it's going to be happening soon, whether they're leaking information, exposing information, dropping bombshells. I know you guys see the headlines, you see the thumbnails and so on. But look, the AMC stock short squeeze comes down to one thing: risk management. Now, you might think that hedge funds are kind of stupid. They're out there, they're taking all these unnecessary risks, but they're very good at risk management. They're very good at staying in control of what they've already got. That is power. So let's talk about things that affect this risk. And when you're looking at money, any investment for that matter, you've got three things to look into: the amount, the time, and the rate. So let's jump into this video and see how these three things could potentially affect the AMC stock short squeeze, and see whether or not it is right around the corner or if we've still got some work left to do. So of course, if this sounds like something you're interested in, let's get started. What's up, everybody? I'm Clay. I'm here to make 2021 the best year ever. If you haven't clicked that subscribe button, make sure to subscribe to the channel. Join us, become a bro. We are here every single day and we are growing our portfolios together. AMC stock is turning out to be a very long investment. It is a long journey. We've been here for the better half of a year. And if you have been here for the better half of a year, you're already making spectacular gains. AMC was trading below $2 and now it's above $40. So think about those returns already. We've come a long way, but we absolutely have so much potential left. The AMC stock short squeeze is going to be talked about for ages, for decades, potentially, if we do what we say we're going to do, for the rest of time. There's that much potential when it comes to AMC. And don't take it just from me. Look into what the experts are saying, the smart money, the so-called guys that are out there that, that maybe have studied finance or that have worked in finance for a while. They understand that it is a risky play, yes, but the potential is unlimited. Now, here's the deal. When you're looking for a margin call or when you're looking for these shorts to cover, they cover in one of two ways. One, they're willing to cover, or two, they're forced to cover. Now, everybody wants them to be forced to cover, and this can only take place when a margin call takes place. And if you're brand new to this whole thing, if you haven't seen many videos explaining it, a margin call essentially says, okay, we're no longer going to lend you these shares. We're no longer going to allow you to use your money in that way. You must go out, and it's a forced liquidation at that point. You must go out and cover these positions. You must go out and get our money back. We cannot afford this risk anymore. So how does that come to be? It's all about risk management, right? It doesn't matter if nobody's going to get margin called if the lender's money is not at risk. So when you're looking at investments, you need to look at three things: the amount, the time, and the rate. So let's break these down and how they can potentially affect the margin call during the AMC stock short squeeze. So right away, one of the rates that you can look at, and there's plenty of different, you can look at the rate of return over a certain period of time and so on. Let's focus on the borrow rate in this example. Currently, it is low. The cost to borrow is roughly averaging between 1% and 2% per year on AMC stock. Now, yes, the maximum cost to borrow is high, but we got to look at the average, right? Just because somebody's paying a very high rate out there doesn't mean that that's affecting everybody. So the cost to borrow average is very low. Now, if you don't yet understand the cost to borrow average, it's very simple. When you go out and you buy a stock, you can hold that stock for as long as you want and you don't have to pay a dime. But if you short that stock, somebody is lending it to you. Now, that lender is charging you. They're just like if you went out and got a loan from a bank, that lender is charging you to borrow that stock. So currently on AMC, the people who are out there shorting, the hedge funds who are out there shorting, are paying roughly 2%. It's between 1% and 2% annual interest to hold that stock. So as you can see, that's very affordable. especially for hedge funds with billions and trillions of dollars out there. 1 to 2% is very affordable. If that rate rises, that is an added risk to the hedge funds. They will not want to keep that short position out there if they're paying 50, 60, 70, 100% annual interest to borrow those short shares, to go out and short them. So keep that in mind. That's the rate that you could look at when determining whether or not a squeeze could be around the corner or whether or not the AMC stock short squeeze could be happening soon. Now, when you're looking at time, in this example, we'll look at days to cover because you can look at all different types of time frames and so on, but days to cover is an extreme risk for short positions. Why? Currently, there's about 100 million reported short shares outstanding on AMC, and roughly 90 million shares are traded on average per day. Now, I know that it's been trending down over the last several days, but the average, the 3-month moving average, is still around 90 million shares per day, and that means that the hedge funds could go out and cover their entire shorts that are outstanding in less than 2 days. That doesn't seem very risky, does it? If the supply is out there and they can go cover basically at will, there's no risk there. Now think about that. If the not the cost to borrow, but if the days to cover increases, if it goes to 5 days, 10 days, 20 days, 100 days. Now, all you got to do there is bring the average volume down, and therefore the cost to borrow, again, my goodness, the average days to cover will increase. Now, you get that days to cover simply by dividing the shares that are outstanding, the short shares that are outstanding, by the daily average volume. So if the daily average volume starts coming down, days to cover will increase. Now, if they know the supply is restricted and they can't go out there and cover those shares, that is a huge risk. Think about it. If there was no food left in the grocery store, or if they were only giving out 1 loaf of bread a day, that's a very big risk if you're hungry, okay? Use it the same way when you're talking about the shares to cover for AMC. If they can't find those shares to cover those short positions, that's risky. Now, the final thing that we can look at is the amount, okay? And the amount that we're going to look at in this situation are the actual short shares outstanding. You can look at this as short interest. Now, short interest is the amount of short shares that are outstanding divided by the amount of shares that are outstanding. So currently with roughly 100 million short shares outstanding and 500 million total shares outstanding, the short interest is somewhere around 20%. Now, of course, if you're looking at an Ortex estimated data, and that's estimated daily, it gives you a good understanding of what's going on day to day. But 20%, that's actually higher than average. So that's starting to get into risky territory for these hedge funds, knowing that 20% of the entire company in AMC is being shorted. So as that number increases, if they continue to short more and more and more, that means that they have to go out and cover more and more and more of AMC. So as you can see, as the short interest rises, that increases the risk for hedge funds. As days to cover rises, that increases the risk for hedge funds. As the cost to borrow rises, that increases the risk for hedge funds. Now, where we're sitting, I don't want to say they're safe. I don't want to say they're under an extreme amount of risk right now, but we need the risk to rise if we expect anything to change here. If the risk isn't rising and they haven't been covering, why would they do so in the future? Think about that. We need a margin call if we're going to force these hedge funds to cover, but if they haven't been covering in the past under similar circumstances, why would they cover in the future under similar circumstances? We need to increase the risk. Therefore, we need to increase these 3 things. Cost to borrow goes up, days to cover goes up, and the short interest goes up, and that's a recipe for margin calls waiting to happen. So guys, let me know what you think down in the comments below, and also inspire the rest of us to keep holding this stock. That is the plan. That is why we are here, and AMC stock will squeeze. And if this button right here is still red, make sure to subscribe, or make sure to click it, subscribe to the channel, join us, become a bro. We are here every single day, and we are growing our portfolios together. If you're brand new to trading, use the link in the description below for Webull. It is super simple to set up a brokerage account, and a $100 deposit is going to get you a couple free stocks just for doing so. They're your stocks, so sell them, keep them, whatever you want to do. ClayBro883 on Twitter and Instagram if you want to follow me there. And of course, guys, until the next time, hope that each and every one of you have an awesome day.